Yo, how's it going, guys and girls? My name's Chris and welcome to my channel, CSM Investing. Do you ever sit there and think, I'm going to put all my money into one stock, what's the point in having more than one? If I put my money into Tesla this time last year, like the lot of it, I'd be a millionaire, so what's the point? Look, your point is valid, and yes, if you did put all your money into Tesla last year, and you had enough money saved up obviously to put into Tesla, you probably would have made a killing. But that's only if you're a massive risk taker. But it could have easily have gone the other way and you would have lost all your money. It's not as easy as everyone thinks finding a gem like a Tesla. You've got to do a lot of research and it's like a one-off situation. Obviously you got your Microsofts, you've got your Amazons. So yeah, like there are different companies out there, but you've got to be able to spot them. As you can see from the title of this video, we're going to be talking about whether diversification is necessary. And the way that we're going to do this is by breaking down what diversification is, how we understand it, how to actually become diversified, so how many stocks you actually need at each level, what type of risks that are involved with it, whether you're diversifying or not, and any problems that come along with that. Look, trust me, I understand this sounds like some boring class essay that I've just written up and I'm just reading off a script to you, but that's not the thing that we need to focus on. What we need to focus on is the understanding of whether you need to be diversified or not, because any intelligent investor knows this sort of stuff. And if you don't know this sort of stuff, then well done for being here. You're going to learn something new. Or if you click off this video now, then you're the complete opposite and you're not a very intelligent investor. You need to understand this sort of stuff, because if you don't, if you're investing and you don't know this stuff, then it's going to be very complicated for you and you're not going to understand what you're actually investing in. And it's just a big gambling game for you. It's not worth doing. So stick around and learn something. I would like to state that I'm not a financial advisor and anything that I do say, please take with a pinch of salt. But trust me, you're going to want to stick around, because I guarantee if you listen and take on these points, you're going to learn something new today. But before we get into any of that, make sure to like, subscribe and hit that notification bell. Right. Let's get straight into the video. So I think the best place to start is by saying what diversification is. What is diversification? Well, put it this way. It's a way of reducing risk and spreading your seed across several different options. In a non-sexual way, of course.
You naughty, you teasing me, you naughty.
So the aim of diversifying is to maximize your returns by investing in different areas that would react differently when the same event happens. I feel like I've made that as clear as possible and I'll put it in the simplest way I know how. But to explain this, if you put all your money into one sector, let's say the green sector, which has been growing quite well lately, and then all of a sudden the legalization of the green stops, your overall portfolio is going to be hit pretty hard. And then if it never picks up because of the non-legalization, you're basically screwed. Now, there are several ways to be diversified. For example, you can be diversified in one sector. So take the green, for example. You can be diversified in this by investing in Planet 13, Aurora Green, and Canopy Growth. That way you're spreading your money in different companies in that one sector. And I've made a whole video on Planet 13 before and talking about how I think that company is going to be near enough every single one in that sector. So if you want to see that, go check it out. Then you're able to become diversified in different sectors. So take, for example, technology sector, healthcare sector, energy sector. So take companies, for example, like Tesla, Enphase Energy, Planet 13, these are all in different sectors. So then you become diversified through different companies. This then gives you exposure to completely different companies. So if one sector is down, your overall portfolio isn't affected. So far, I've only mentioned stocks and shares, but to be ultimately diverse, you can invest in different sections such as stocks and shares, bonds, real estate, or even a business. That way, not all your money is tied into one whole section. And just like stocks where you spread across several different companies, if one section, such as stocks, is down, your whole portfolio won't be, because you've got cash flow coming in from rental properties, you've got steady income coming from bonds, and you're making profit from a business that you've started. I bet you're there going, Jesus, I've literally been sat here for ages. All I want to know is, how many stocks do I need to be diversified? And this geezer's just here waffling on, giving me all this information that I already knew. Well, now you can relax, you can breathe, you can chill, because we're about to get onto that now. So in order to be truly diversified, it has been shown that you only need 15 to 20 stocks that are spread across different industries. Now, with a quick Google search, that is clearly obvious, and it's a very broad statement. But at what stage are you meant to have 20 stocks? And how much are you actually meant to invest in each area? Well, to be honest, that last part, that's completely up to you. But now we're going to discuss how many stocks you need compared to how much money you have. This is all in my own opinion, so if you do decide to take this on, just DM me on Instagram, CSM_investing, and let me know what you brought and let me know how it went for you. If you're on a lower end budget, just like I was when I first started investing, aim for around 10 to 6 stocks. Now, this is if your budget is around $0 to 15k. Now, yes, I do understand that you can't invest $0, but the frame's there for obvious reasons. If you only have $200 to start, don't straight away try to break into 6 to 10 companies, because it's not going to work. You're going to spread yourself too thinly and you're not going to make enough profit. So do your research on around 10 to 6 companies, and then once you've done that, find the best one, the one that's going to make you the most profit, then expand from there. If you're in a range of 15 to 50k, I recommend, to be diversified, put your money into 10 to 15 stocks. Now, obviously, you want to spread this around different sections to be diversified. With 50k to 85k, have around 15 to 20, and then anything above 85k, go for around 25 to 35 stocks. Yes, it does say to be truly diversified, you only need 15 to 20 stocks. But as I said, this is a very broad statement and it doesn't take into account how much money you actually have. So if you are in the higher bracket, I do suggest putting your money and spreading it around a little bit more. I do want to take a minute and say that if you're not able to keep up with what the company is actually doing, that's when you know that you're spreading yourself too thin and you need to cut down on the amount of investments that you're actually in. You always need to be able to keep track of what each company is doing, and if you're not able to, get out of some of them. There are different risks that are associated with diversifying. The first one is systematic or market risk. This is the type of risk that affects every company. The common causes of this are inflation rates, exchange rates, political instability, war, and interest rates. This category of risk is not specific to any company or any industry, and it cannot be eliminated through the process of diversification. It's just a form of risks that us as investors must accept. As well as the risks of diversifying, there can be problems with it too, as it can be very time consuming and kind of hard to keep track of all the companies that you're invested in, especially if you're a new investor, and it can be very overwhelming. So if you're a new investor, you may end up quitting at the first hurdle. But seriously, don't be intimidated. I suggest not quitting at all because there are loads of resources out there that can help you. And if you want me to make a video on what is out there, then comment below with a thumbs up, and if there's enough interest, I'll make a video on it. Sometimes diversifying isn't for everyone, as it can be expensive, as different companies cost different prices. And yes, it may be low risk, but it can also be low reward. And that's not appealing to everyone. But then solely focusing on maybe one or two companies can be very high risk, but also high reward. So in the long term, with diversifying, you might be limiting your returns. Just each time evaluate your risk tolerance. My final thoughts here are that sadly, even the best analysts of a company and its financial statements can't guarantee that the company will win. Look, diversification won't prevent a loss, but it can prevent against bad information and fraud against your portfolio. So in my opinion, being diversified is of the utmost importance, especially if you don't want to lose all your money from having one or two stocks. Yes, they may blow up and you may make millions, but that is very risky and it's not the safest place. Like, I like to know that my money will grow consistently with low risk. It's completely up to you what you do. As I've said, I'm not a financial analyst and advisor, whatever, but I've given you all the information. It's up to you what you do. I'm Chris, and thanks for coming to my channel. Peace.